Imagine having a tool that not only tells you when traders are buying and selling, but exactly where they find value at different price levels. That is exactly what we are diving into today. Hello everyone and welcome. Today we are going to explore a really interesting topic that can make a big difference in your trading journey. We are going to be talking all about the volume profile indicator. By the end of our time together, you will understand exactly what volume profile is, how to use it, and why it can be a game changer for your trading strategy. We are going to cover everything from understanding the basics to exploring some great trading strategies that use volume profile. So stick around because you are not going to want to miss any of this. Let us start at the beginning. What exactly is volume profile? Imagine being able to see not just when people are buying and selling, but at which prices they are doing so the most. That is exactly what volume profile helps you with. Unlike the typical volume bars you see that only show you how much trading activity happened during a specific time, volume profile goes one step deeper. It shows you how much trading happened at each price level. This gives you a window into where most traders think the price is fair and where they were happy to buy or sell. It gives you a clear understanding of where the most important support and resistance levels are, and that can help you make much better trading decisions. To expand on this, understanding chart patterns can add even more depth to your analysis with volume profile. Chart patterns are visual representations of price action that help you identify potential trends and reversals. Some of the most common chart patterns that work well with volume profile include double tops and double bottoms, head and shoulders, and triangles. A double top pattern occurs when the price reaches a high level twice, failing to break through on the second attempt, which indicates a potential reversal. When a double top forms near a high volume node, it is a strong signal that the price may reverse from this resistance level, providing an opportunity to take a short position. On the other hand, a double bottom is the opposite and forms when the price hits a low level twice without breaking further down, suggesting a possible upward reversal. If this happens near a high volume node, it indicates strong support and a potential buying opportunity. Another important pattern is the head and shoulders, which is known for signaling a trend reversal. It consists of three peaks where the middle peak is higher than the other two. If this pattern forms near a point of control, it can act as a powerful confirmation of a coming reversal. Conversely, an inverse head and shoulders pattern signals a potential move upward and can also be very effective when paired with volume profile levels. Triangles, such as ascending, descending, and symmetrical triangles, are continuation patterns that show a period of consolidation before the price breaks out. If a triangle forms near a low volume node, you can expect a quick breakout when the price moves through the apex of the triangle. Volume profile helps confirm whether there is enough interest in that price area for a strong breakout. By combining volume profile with these common chart patterns, you can gain more confidence in your trades and improve your timing. For example, when you spot a head and shoulders pattern near a point of control or see a double bottom forming near a high volume node, you have a greater chance of predicting the market's next move. Understanding these chart patterns alongside volume profile can be a key part of a well-rounded trading strategy. How does the volume profile work, you might ask? Well, the way it does this is by plotting a histogram along the side of your price chart. This histogram shows how much volume has been traded at each price level, not over a period of time. When you look at the histogram, you will see that some areas have lots of activity while others have less. The areas with high trading activity are the places where traders were the most interested. Think of these as hot spots on the chart, while the areas with low activity are more like cold spots. These cold spots are where the price was not very interesting to most people, and it tends to move quickly through those areas. Now let us break it down even more. There are a couple of really important parts of volume profile that you should understand. Let us start with something called high volume nodes. These are the areas on the chart where a large amount of trading happened. Think of these as major support or resistance levels. These are the levels where traders are comfortable. If the price is hanging around a high volume area, it is because buyers and sellers find it fair. Then there are low volume nodes. These are the places where there was not much trading. These zones tend to be the areas where the price moves quickly. Think about it this way: if the price is in a low volume area, it is likely to break out or make a sharp move. Chart patterns can be extremely useful when working with these nodes, and expanding your knowledge of these patterns can greatly improve your trading decisions. Let us discuss some of the key chart patterns in more depth. One of the fundamental chart patterns is the double top and double bottom. A double top occurs when the price reaches a peak level twice and fails to break through, which signals a potential reversal. This pattern becomes especially significant when it forms near a high volume node, as it suggests that the price is encountering strong resistance. A double bottom is the opposite, where the price finds a low point twice without breaking further down, indicating a potential upward reversal. When this happens near a high volume node, it means there is strong support and an opportunity for a bullish move. Another highly influential pattern is the head and shoulders. This pattern consists of 3 peaks, with the middle peak being the highest. It typically signals a bearish reversal. When this pattern forms near a point of control, it serves as a powerful indicator that the price may be heading lower. The inverse head and shoulders is the opposite, with a lower middle peak, and indicates a bullish reversal. Volume profile can help you confirm these patterns by showing if the point of control aligns with these levels, giving you a higher probability trade. Triangles are another set of common chart patterns that traders frequently use. There are 3 types of triangles: ascending, descending, and symmetrical. Ascending triangles are characterized by a flat top with higher lows, which often signals an impending breakout to the upside. If this pattern forms near a low volume node, the breakout is often sharp and rapid, making it an excellent opportunity for quick gains. Descending triangles are the opposite, with a flat bottom and lower highs, indicating a potential breakdown. Symmetrical triangles have converging trend lines, showing that the market is in a consolidation phase before a breakout in either direction. Volume profile helps you assess these breakouts by indicating whether there is enough interest in those price levels for a strong move. Flags and pennants are continuation patterns that also work well with volume profile. A flag is a small, rectangular consolidation after a strong move, either up or down, and signals that the trend is likely to continue. When a flag forms near a low volume node, it suggests that the breakout could happen quickly as the price moves through the area with little resistance. Pennants are similar but are more triangular in shape. When combined with volume profile, these patterns can give you a clear signal on when to enter a trade and ride the continuation. Wedges are another type of pattern to be aware of. Rising wedges and falling wedges both indicate a reversal. A rising wedge forms during an uptrend and suggests a potential reversal to the downside, especially when it forms near a high volume node, indicating heavy resistance. A falling wedge forms in a downtrend and points towards a reversal to the upside. These patterns, combined with key volume levels from the volume profile, can provide very accurate trade entry and exit points. Rounding bottoms, also known as saucer bottoms, are patterns that indicate a gradual change from bearish to bullish sentiment. These patterns often take longer to develop and signify a slow accumulation phase. If a rounding bottom forms near a high volume node, it strengthens the idea of a sustained move upward as significant interest is building at those levels. By expanding your understanding of these chart patterns and combining them with volume profile, you gain valuable insights into market behavior. Each of these patterns has unique characteristics that, when paired with high volume nodes, low volume nodes, or the point of control, can give you a powerful edge in predicting price movements. Remember, volume profile not only tells you where the activity is, but, when combined with these patterns, also helps you understand why the price is reacting in a certain way. This thorough approach can give you more confidence and precision in your trading strategy. Let us go even further into the key components of volume profile. One of the most important levels that volume profile gives you is something called the point of control. This is a very special price level because it is the price where the most trading volume happened. Think of it as the center of gravity for the market. When the price is near the point of control, it means that the buyers and sellers are in agreement. It is where everyone feels that the price is fair. The price tends to come back to this point during quieter times when the market is consolidating. Another important part of volume profile is the value area. This is the price range where about 70% of all the volume took place. It is like a zone of comfort for the market. If you are looking to find the important price levels to watch, the value area is a great place to start. Within the value area, you will also have the value area high and value area low, which are the boundaries of this comfortable trading zone. When the price gets close to these levels, it is like approaching the edge of a cliff. Either it bounces back or it moves into a new area. Let us now expand on how chart patterns can interact with the value area to provide powerful trading opportunities. One useful pattern is the cup and handle. This pattern often forms when the price is within the value area, showing a rounded bottom followed by a small consolidation, which resembles a handle. If the handle forms near the value area low, it may indicate that the price is ready to break out higher towards the value area high. This setup can offer a low-risk entry with the potential for significant gains if the breakout is strong. Another important pattern is the rectangle or range pattern. This forms when the price repeatedly tests the value area high and value area low, creating a consolidation range. This pattern is significant as it shows market indecision. If the price breaks out above the value area high, it signals a potential uptrend, whereas a break below the value area low could lead to a downtrend. Using volume profile in combination with the range pattern can help you understand whether these breakouts have enough volume behind them to be sustainable moves. The bullish and bearish engulfing patterns are also valuable to recognize. A bullish engulfing pattern occurs when a small bearish candle is followed by a larger bullish candle, completely engulfing the previous one. If this pattern forms near the value area low, it could indicate that buyers are stepping in and a move towards the value area high is possible. Conversely, a bearish engulfing pattern near the value area high signals potential resistance, and a move back towards the value area low may be in play. Another interesting pattern to be aware of is the rising or falling channel. These channels represent a steady trend with price action moving within parallel lines. If a rising channel forms and the price is nearing the value area high, it can indicate that the price may be overextended and ready for a correction back towards the value area or even the value area low. Conversely, if a falling channel is approaching the value area low, it may signal that the market is ready to reverse and head towards the value area high. Finally, let us not forget the concept of price rejection wicks. These occur when the price attempts to break through either the value area high or low, but is pushed back, leaving a wick behind. When you see a long wick at the value area high, it can indicate that sellers are defending this level, suggesting a move back into the value area. Similarly, a long wick at the value area low can indicate strong buying interest, suggesting a move upwards. Volume profile helps confirm these rejections by highlighting the volume at these key levels, giving you insight into whether the rejection is likely to hold. Understanding these chart patterns within the context of the value area can help you make better informed decisions. The value area gives you a clear zone of interest, while the chart patterns give you the timing and directional cues. When combined, they become a powerful tool for anticipating the next market move. Now, let us talk about how to actually read and interpret the volume profile. You are probably wondering what it means when the price is near these different areas. Well, when the price is near the point of control, it is often a sign of balance. The market is in agreement, and we usually see the price moving slowly or consolidating here. But if the price starts moving towards a high volume node, it is drawn to this area. You can think of these levels as magnets that pull the price in because of all the interest at those levels. On the other hand, if the price gets into a low volume node, you can expect sharp movements. There is less interest here, and the price tends to move quickly through these zones. So now that we know what all these different levels are, how do we use them to trade? Let us start with a strategy called trend, following with the point of control. If you see a trend in the market and the price pulls back to the point of control before moving again in the direction of the trend, this can be a great entry point. The point of control acts as strong support or resistance in these scenarios. Another strategy is to trade within the value area when the market is moving sideways. If the market is ranging, the price tends to move back and forth between the value area high and the value area low. You could buy near the low and sell near the high, or do the opposite. This is often called range trading. When using range trading, it is helpful to watch for chart patterns such as double tops or double bottoms forming near the value area boundaries. A double top forming near the value area high could signal a good point to exit a long trade or enter a short position, while a double bottom near the value area low could indicate a buying opportunity. We also have the breakout trading strategy. When the price breaks into a low volume node, you can expect it to move quickly. If you catch it at the right time, you can ride the wave as the price moves quickly through that low volume zone. This strategy works well with patterns such as triangles or flags. For instance, an ascending triangle forming near a low volume node may signal a strong bullish breakout. Likewise, a descending triangle at a low volume node could indicate an impending bearish move. Recognizing these patterns gives you a clear indication of where the price might be heading once it breaks out. Another advanced strategy is to use volume profile in combination with the head and shoulders pattern. If a head and shoulders forms near the point of control, it can serve as an especially strong signal of a potential reversal. This pattern tends to be more reliable when there is significant volume at the neckline level, which volume profile can help you confirm. The inverse head and shoulders is also effective in bullish scenarios, particularly when the neckline aligns with a high volume node. Wedge patterns can also be effective when combined with volume profile. A rising wedge forming near a high volume node can signal exhaustion in an uptrend, suggesting a possible reversal to the downside. Conversely, a falling wedge near a low volume node could indicate a strong breakout to the upside. These wedge patterns can help you time your entries and exits with greater precision. By understanding how these different chart patterns interact with volume profile, you can develop a well-rounded and robust trading strategy. Combining these tools allows you to spot opportunities that other traders might miss and to execute trades with higher confidence. If you really want to strengthen your trading strategy, you can combine volume profile with some other indicators. For example, using moving averages is a good way to confirm whether the market is trending. If the price is also above a key moving average when it is near the point of control, it is a good sign that the market will keep moving up. Another useful indicator is the relative strength index. The relative strength index can help you understand whether the market is overbought or oversold. If the price is near a low volume node and the relative strength index shows that the market is overbought or oversold, it might confirm a breakout or reversal. And of course, good old support and resistance levels. These levels are even more powerful when used with volume profile, giving you more confidence in your trading decisions. But there are also some common mistakes to avoid when you are using volume profile. One of the big mistakes is trying to make things too complicated. It is easy to get overwhelmed by all the details, but focus on the main aspects like the point of control, value area, high volume nodes, and low volume nodes. Another mistake is ignoring the broader market. Remember, volume profile is a powerful tool, but it should not be used in isolation. You need to consider the broader context, including market trends, news, economic events, and other factors that can impact the market. Additionally, some traders may over-rely on a single chart pattern without considering the complete picture, such as how the pattern interacts with key volume profile levels. Finally, do not trade against the prevailing trend. Volume profile can give you valuable insights into market behavior, but it is always better to align your trades with the overall market direction for a higher probability of success. Now let us talk about some practical tips for using volume profile. First, it is a good idea to use longer time frames if you want stronger signals. If you use daily or weekly charts, you will get much more reliable information compared to using short-term charts. Second, look for confluence with other tools. If a level in the volume profile matches up with a moving average or a Fibonacci level, you have a stronger setup. Third, keep track of how the volume profile changes over time. As new high volume areas emerge, they can give you new insights into where the price might find support or resistance in the future. And here is an advanced tip for those of you looking to take your trading to the next level. Try developing a customized trading plan based on the point of control and value area. You could enter trades near the value area low and then set your target at the point of control or even the value area high. You can even set alerts when the price reaches these important levels so that you do not miss any good opportunities. So to recap, we covered a lot today. We learned that volume profile is a powerful tool that shows you where the most trading activity happened at different price levels. This helps you see where the important support and resistance zones are. Start by adding the volume profile to your charts and focus on the point of control, value area, and high volume nodes. Use these levels along with other indicators to make your trading strategy even better. If you have questions or if you want to share your thoughts, do not hesitate to jump in and engage with this. We are all learning together, and your perspective is valuable. Keep practicing, keep refining your strategy, and remember, patience and consistency are key to becoming a successful trader. Happy trading, everyone!